S&P could have had what they call an outside session. But that means it would have to close above 36.52. Now that would be a buy signal for many folks. But how do we get the ultimate buy signal? Joining me now, Michael Lee, strategy founder Mike Lee. All right, Mike, I know you at this point believe that the market is 100% Fed driven, which is tough for investors because now you have to put yourself in the mindset of the Federal Reserve, the same Federal Reserve that missed the transitory debacle, that seems dead set on destroying the economy, and ignores data like the data we had this morning from the New York Fed, which I know it sparked this rally, but it seems like, the rally's starting to fade already.
Yeah, look, it's we are in a transition period, and these transition periods are ugly. So 2018 was the last time we went through something like this. Greatest year of earnings in the history of the S&P 500 to date. But the market, I think, was flat or positive for that year, even though earnings were up 30%. So when these rate changes happen and you have a completely different shift in where the 10-year is going to live and where short-term interest rates are going to be, and what the Fed is doing with their balance sheet, it becomes a very difficult time for equity investors.
You have to adjust then the valuation of, in other words, how we value companies in these higher interest rate environments. Does it have to be as dramatic as it is, or could we even begin to argue that some of it is being priced in right now?
Yeah, so I think the market is trying to get their arms around how far the Fed's going to go and where the 10-year is going to live, because your 10-year is your risk-free rate. So if we have a 2% 10-year and you have a 20 PE multiple on the S&P 500, that gives you a 5% earnings yield, so 1 over 20. So if that 10-year is now going to live at 3.5%, 4.5%, what does that multiple become? Does it go below that long-term average of 15 or 16? I think so. I don't think it. If the 2 years
does it go below and stay below though?
Until that rate paradigm changes, and I tend to think the more the Fed gets this wrong, the more they're going to have to cut rates the other side. Right. So you could see that 2% 10-year again with some good growth on the other side of this.
So you're not in the camp then that says we've had a 40-year secular bull market in bonds, and now we can have a 40-year secular bear market. You think at some point the Fed's going to blink and the yields will come back down?
Well, I think at some point this train is going off the tracks with the amount of debt there is.
Right.
But because there is so much debt, we can't have these ultra high interest rates. And I'm with Jeff Gundlach on this, in that the Fed should only raise a little bit more and then focus on their balance sheet.
Right.
Because you've done a lot of damage on the front end, and raising interest rates in the short term only does so much for inflation.
Right, paying $700 billion on interest alone, going to $1 trillion. You're right, the Fed's going to have to blink. You made an interesting observation about buying energy on down days. Energy, I think, is a really great safe haven with upside potential, and selling high multiple stocks on down days. But I feel like these high multiple names are down so much. It feels like it might be too late. I mean, we're talking about even on up bounce days, right? You're still losing 30, 40%. Is it at the point where people still take those kind of losses so they have fresh powder, or
it depends on
if you've waited that long, you know?
Well, so names I'm looking at specifically, if Apple has become an outsized portion of your portfolio, maybe at the end of last year or in the middle of last year it was 5 or 10%, and now it's 25.
Right.
On some of these bounces, you might want to take a little bit of that off the table. And then looking at these energy stocks, I mean, in energy, you still have a war on fossil fuels. You have OPEC cutting production, and it looks like tensions are escalating between OPEC and the Biden administration. And also, what a lot of people don't realize is that in Russia, they've been able to keep their production steady and send it through other channels. Well, all their oil rigs and all their methods of getting it out of the ground, those need to be serviced. A lot of that service and the new parts that would come into all these machines came from the likes of Chevron and different places in America. Right. And with the sanctions, at a certain point, that's going to have to come offline potentially this winter, which gives you more of a bull case for the price of oil.
Right, which is ironically what happened with Venezuela, right? They've got all the oil in the world, but they have some, the infrastructure is awful. Mike, great stuff. Really appreciate it. Talk to you again real soon. All right, folks. So